But Jim, we had Disney reporting a quarter. It was light on revenue. What was your takeaway? Stock is up today.
Disney wanted to be light on revenue. The decision to be able to not have profit lists, this is like a profitable growth story now. Bob Iger made a decision. There was too much money being lost making movies in order to be able to satisfy revenue and satisfy Wall Street. And he realized that, wait a second, when you have a Cars franchise, when you have a Toy Story franchise, when you have a Pirates franchise, when you have Marvel Comics franchise, you stick with those. Look at Harry Potter. Every iteration of Harry Potter made a lot of money. Every iteration of Toy Stories, Pirates made a lot of money. So let's stop just constantly reinventing the wheel. Let's stop doing a huge number of movies and some are losses, and let's just go with tried and true, kind of like, let's look at it like, let's go with Procter & Gamble. We'll do one form of Tide and then another form of Tide, and go for more bankability, which is something Time Warner's been doing all along, and Time Warner's been the most consistent player. So the revenue light is wrong. What happens is that Wall Street got the revenues wrong because Iger has decided to go for profitability. I think it's a very smart move. Again, one of my themes of 2012 is that the analysts are powerless here. The analysts aren't making you any money. Either the analysts haven't figured out the stock market. I've got a piece right now, contrary to Doug Cass, about Morgan Stanley. Two guys downgraded Morgan Stanley. If you believe, like I do, that this market has characteristics of a true bull market as opposed to the phoniness that we've had for the last 12 years, pumped up either by the Fed or a short squeeze, whatever, then you take a look at what a Disney's doing and you recognize what he's trying to do is say, listen, I'm going to grow at a reasonable pace and make a lot of money and return it to shareholders. That's what I want.
But obviously don't pay up for it, right? So you have to wait?
Disney's not expensive. Okay. It's not expensive. The variability to Disney was bombs, bad movies, and he's taking that off the table.
And theme park growth was at 10%.
Growth really shocked me, given the fact that gasoline's up and the consumer's supposed to be stretched. But one of the continual themes that I've been focused on is that the stretched consumer hasn't panned out as a thesis. Consumers refinancing. Consumer has more money than people realize. Consumers a lot of pent-up demand. I don't want to whistle past the $4.50 gas graveyard, but you have to be empirical about this and say that when Ralph Lauren's up 15 and Disney's really good and Nordstrom hitting a 52-week high and Macy's hit a 52-week high and
JCPenney's near a 52-week high.
You got to come back and say, well, look, maybe my thesis is wrong. We are always loath to ever think that we got anything wrong. I mean, when I say that I've got something wrong, people say I'm a flip-flopper. I'm not running for president. I don't care about whether I flip-flop. The facts flip-flop, okay? And one of the things that I see when I'm attacked like that, those are younger people. And that's okay. I mean, I'm not young. And when I see that kind of charge, I can easily say, well, hold on, I got to think, did I do it right? Or I got to think, like, why am I here? Like, why am I still in this business? Like, I'm not getting existential. I'm just saying historically, like, I made a lot of money, and these people who are criticizing me, they probably haven't, or they will maybe one day, if they drop the pretense that this is politics. It's not politics, it's money. I mean, I could go back and be a hedge fund manager. Do that tomorrow. Raise $1 billion. I mean, it's not my goal. So then really quickly, if the analysts are really off the mark, when we're going into Cisco and say Groupon tonight, what do you really need to hear? Well, I mean, Cisco could be, we've heard from a bunch of companies in the industry of telecommunications. Some have been very good and some have been very bad. We own Juniper Fractional Alerts has been horrendous. Right. Okay, just horrendous. And they do have a new product cycle, but Cisco, I think, has taken some share, and there was a pause in spending by AT&T because of the T-Mobile deal. But I think that that John Chambers has set the company up to make a couple of really good quarters, and the Wall Street's very subdued about it. Remember, this was a $23, $24 stock for a very long time, and it's entirely possible it could go back there and really not stretch the valuation parameters. Groupon's a strange animal. I mean, more a trading vehicle? What, Cisco? No, Groupon. I have no idea what Groupon. I mean, Groupon is a part of a new cohort of unseasoned stocks that don't lend themselves to security analysis, so we shouldn't pretend that they do. Fair enough, Jim. Thanks. Yeah.